In today's video, we'll do a detailed analysis of one less popular, actively managed large cap fund, that is Nippon India Large Cap Fund, and try to understand that should one invest in this fund now or should invest in an index fund. Hello everyone, I am Dhaval and welcome to my channel DIY Find. I have not posted any new videos since more than a month, and quite a few of you had inquired also about the same. So I would like to inform that I had been on a trip to USA to meet my son, who has recently completed his PhD in computer science and is now working as a research scientist in California. In New York, I had a chance to visit New York Stock Exchange and had the opportunity to catch the bull with its horn. Let's hope we will be able to tame this bull in our favor. So, coming back to the video, let's start the video with the basic details. Firstly, the AUM, that is the total asset under management, which is about 15,850 crores, which I feel is on a lower side as compared to other funds in the category. While the expense ratio is 0.90%, which is okay when compared to other schemes in the category. The benchmark index, that is the reference against which the scheme is compared, is S&P BSE 100 TRI. Now let's look at the sector-wise allocation. From the graph, it is very clear that the fund is heavily invested in financial sector, followed by services, energy, consumer staples, and technology. When the sector allocation is compared to its benchmark, the allocation is quite different, except for the energy and consumer staples. Now let's look at the top holdings. As evident, HDFC Bank, ICICI Bank, State Bank of India, and Axis Bank are the main stocks of the financial sector, whereas Reliance Industries and NTPC are from the energy sector. L&T is the main stock from the construction sector, whereas ITC and Hindustan Unilever are the main stocks of the consumer staple sector. Now let's check the portfolio allocation. Here if you observe, large cap stocks form around 87% of the portfolio, whereas mid cap stocks form other 11% of the portfolio, whereas less than 1% is allocated to small cap stocks. The lower allocation to mid and small cap stocks should make the portfolio less volatile. Let's see this in the later part of the video, whether really the fund is less volatile or not. The portfolio is slightly concentrated as there are only 55 stocks and the top 10 stocks form around 48% of the portfolio, whereas top 3 sectors contribute to around 58% of the portfolio, with around 33% coming only from the financial sector. Here, the portfolio PE and PB are also on a quite higher side, which suggests the fund has most of the growth stocks in its portfolio. Now let's look at the fund managers. Mr. Shailesh Raj Bhan has been managing this fund since January 2013, that is, since the inception of the scheme. He has been joined by Mr. Ashutosh Bhargava in September 2021. Here, the long-standing association of the same fund manager with the scheme is an advantage for the scheme. Now let's compare the returns. Firstly, the trailing returns. Here if we observe the long-term as well as short-term performance, the fund is able to beat its benchmark and its category, and that too with a good margin. Hence, from the trailing returns table, the fund's performance looks excellent. But let's check the other returns and confirm whether this is true or not. And if so, why the fund is not so popular. Now let's check the calendar returns. Here we have data available from 2014 to 2022, that is 9 years. And in this 9 years, fund has been able to beat its index and the category 5 out of 9 years. If you observe, the major outperformance has come in last 2 years, that is 2021 and 2022. Hence, we can conclude that the fund's performance is not very consistent but cyclic in nature. Now let's also check fund's performance for this calendar year. As evident in the graph, the fund's performance has been quite better than its index and the category for all the 8 months of 2023. This is a good sign, as most of other funds have struggled to beat its index in this year. Now let's also quickly check the rolling returns. Here we have rolling returns for the period 1 year, 3 year and 5 years. For 1 year period, the fund is able to beat its benchmark 71% of times, whereas for 3 years period, it is able to beat its benchmark 73% of times. And for 5 years period, it is 86% of times, with almost zero negative returns. Surely, this performance can be considered good, but not the best, and the ratios not reaching 100% of times is due to the inconsistent in the performance of this fund. Now let's see how the fund performs on risk parameters. Here we compare the parameters with the benchmark index and the category average. First, the mean returns, that is the average return in a year, which is 26.24, which is higher than both the category average and the benchmark. Here, higher the value is better. Second one, standard deviation, that is a tool to measure how much the returns have deviated away from the mean returns, which in this case is 15.89, which is more than both the category average and the benchmark index. Here, the lower the value is better. Third one, Sharpe ratio, that is a tool to measure the risk-adjusted return, which is 1.38, which is more than both the benchmark index and the category average. Here, higher the value is better. Fourth one, beta, that is the volatility of the scheme compared to the benchmark, which is 1.06, which is more than the category average. Here, lower the value is better. Fifth one, alpha, that is a tool that measures how much better the fund has performed compared to its category. Here, it is 4.71, which is higher than the category average. Here, higher the value is better. From the risk parameters, it can be concluded that the fund is able to generate better returns than its index, but the fund is also more volatile than its index. So now let's see the upside and downside capture ratios. The upside capture ratio is the measure of how the fund performed relative to the index during the period when the index rose. Here, the value is 114, which indicates that the fund outperformed 14% more than the index during the rise period. Here, higher the value is better and should generally be more than 100. The downside capture ratio is the measure of how the fund performed relative to the index during the period when the index has dropped. Here, the value is 88, which indicates that the fund declined 88% as compared to the index during the fall period. Here, lower the value is better. The upside ratio is quite good, while the downside ratio is okay, and it has been generally observed over long runs that funds having a good ratios have a potential to generate excellent performance in long run. So now coming to the conclusion, what investors should do. But before concluding this video and suggest what investors should do, I would request all of you that as you have watched the video till now, it seems that the topic is of your interest. Hence, I would request all of you to hit the like button and also subscribe to my channel if you have not done till now to watch such interesting videos in future also. So now let's look what investors should do. First, the existing investors. The fund's performance has been quite good since last 2.5 years. Hence, I feel there is no need for the existing investors to worry and can continue their investment in this fund. But keep in mind that the fund's performance has not been that consistent and is volatile. So, if you are planning to continue the investment, be mentally prepared for the ups and downs and stay invested for a longer time horizon. Second, new investors. If you are looking for a better returns than the index, then surely you can think of starting an investment in this fund. But keep in mind that this performance comes with extra volatility, which can make you restless in short to medium duration. If stability with reasonable returns is your aim for investment in large cap funds, then this fund is not for you. In that case, I would suggest that one should go with Sensex or Nifty index funds from HDFC, Bandhan, UTI, etc. I would like to add that presently I do not have Nippon India large cap fund in my portfolio and not planning to start investment in this fund as I already have my investment in other large cap index funds. I will again try to review this fund after 6 to 7 months and check its performance. So stay tuned to my channel. Please subscribe to my channel if you have not done till now and also press the like button. Do check my older videos. Click the attached cards to watch the videos. Thank you.